7 of the 8 largest landlords in America are now selling houses, not buying them. That's not my opinion. That's the finding from Parcl Labs, the data platform the Wall Street Journal profiled on its front page for the exact reason that it tracks every shell LLC back to its real corporate owner. Invitation Homes, American Homes for Rent, Pretium, Cerberus, Blackstone. The names you've been told for 5 years are buying every house in your neighborhood. They're not. They're listing. They're cashing out. They're handing the keys back to families. So today I'm explaining the second half of that story. What Wall Street is doing with the money instead. Because here's the part the headlines missed. They didn't leave housing. They moved it. And the destination is going to change your city's rental market and your kids' chance at home ownership for the next decade. I'm going to walk you through 3 pieces of evidence, every one of them traceable to a federal filing or a primary data source. First, the exact dollar amount Invitation Homes spent buying back its own stock in a single quarter, and what it tells you about where Wall Street thinks home prices are heading. Second, the $3 billion partnership Taylor Morrison just inked in writing that almost no one in the housing media covered. And third, the Sunbelt metros where the entire institutional disposition wave is concentrating. And why, if you're a first-time buyer in one of them, the next 12 months may be the most favorable window you'll ever see. Let's start with the data nobody on cable finance can spin. Parcl Labs published their entity resolution analysis in October. They take every obscure LLC, and there are thousands of them, and they map each one back to the parent corporation that actually owns it. This is the exact methodology that earned them front-page Wall Street Journal coverage. The finding? Of the 8 largest institutional single-family landlords in the country, 7 are now net sellers. First Key Homes, owned by the private equity giant Cerberus, has the most houses listed for sale, 904 of them, 1.9% of their entire portfolio on the market simultaneously. And here's where it gets specific. Half of all institutional homes currently listed for sale are in just 3 cities: Atlanta, 771 listings, Miami, 336, Houston, 269. If you're a buyer in any of those 3 metros right now, you're in the strongest negotiating position you've had in 5 years, and almost nobody is telling you that. Now look at the operating REITs themselves. Invitation Homes, the largest single-family landlord in America, published their first quarter 2026 numbers on April 29th. Total dispositions of 483 houses for $206 million. Net seller of 222 wholly owned homes, meaning the dispositions outpaced acquisitions by that margin. On the earnings call the next day, Chief Investment Officer Scott Eisen said this out loud, and I'm quoting from the transcript. The company's forward backlog of new homes is down from almost 2.7 thousand homes in the backlog at our peak in Q2 2024. The current backlog? 556. That's an 80% collapse in under 2 years. American Homes for Rent reported the same story in a different accent. Listen to this from their second quarter 2025 earnings call. Also a direct quote from management. Our team reviewed tens of thousands of potential acquisition properties. The vast majority of these properties still do not meet our disciplined buy box criteria. And we ultimately acquired a total of just 5 homes, 5 houses, after reviewing tens of thousands in a single quarter from the second largest institutional single-family landlord in America. This is the largest, most watched corner of the rental housing market in the country, and the buying has effectively stopped. So if they're not buying houses, what's happening to the cash? 2 destinations, stock buybacks, and entirely new neighborhoods. The buyback story first, because it's the cleanest signal. Invitation Homes, in a single quarter, repurchased $500 million of their own stock, fully exhausting a $500 million authorization their board approved on October 28th of last year. Then in April, the board authorized another $500 million on top of it. American Homes for Rent followed an almost identical playbook. $359 million of buybacks across 6 months from October through April, then a new $500 million authorization on top. Translation? The 2 biggest institutional landlords in America looked at the option of buying houses at today's prices and the option of buying back their own stock, and they picked the stock every single time. That's a vote of no confidence in the current entry price of American single-family homes from the people who buy them at scale. They don't think the math works. But here's the pivot. They didn't pull capital out of housing entirely. They moved it. Instead of buying lived-in homes, they started commissioning entire neighborhoods. You may have driven past one without realizing what you were looking at. They look like normal subdivisions, single-family houses, two-car garages, kids' bikes in the driveways. The difference is that no individual in those communities owns any of those houses. Not one. The entire neighborhood, every house on every street, is owned by a single corporate landlord and rented out by the same property manager. The industry calls this build to rent, and that's exactly the destination Wall Street pivoted to. According to the U.S. Census Bureau and the National Association of Home Builders, single-family built-for-rent starts more than doubled between 2020 and 24, reaching approximately 84,000 in 2024, the highest in the data series history. According to Yardi Matrix, more than 110,000 of these homes are under construction across the United States right now, across 613 separate communities. And the Sun Belt is where it's concentrated. Phoenix alone has 13,113 of these homes under construction. One metro, more units in the pipeline than the entire Midwest combined. If you've been told for the last 5 years that Wall Street is buying every house in America, what I just walked you through is a complete inversion of that narrative, and it has direct consequences for your home's value, your rent, and what your kid will pay for their first house. This channel exists to give you the second-order data that financial news doesn't have time to translate. Hit subscribe, turn on the bell, and stay with me. The next half of this video is where it gets ugly. Now, to the deal I promised you in the hook, the one almost nobody in housing media reported. In July of 2025, the publicly traded home builder Taylor Morrison announced a $3 billion partnership with Kennedy Lewis Investment Management. $3 billion in committed land and construction financing, entirely earmarked for build-to-rent. Taylor Morrison's BTR brand is called Yardly. They already have around 36 active project sites. The Kennedy Lewis money funds the next wave. Then, a few months later in November, Taylor Morrison sold their Yardly Paradisi community in Surprise, Arizona, 193 finished rental houses, to Christopher Todd Capital for $55.2 million. Bright House Financial provided a $32.76 million loan to finance the purchase. This is the new playbook in one transaction. The publicly traded home builder builds the neighborhood. An institutional buyer scoops the stabilized asset. A life insurance company finances the deal. The renters never see a Wall Street logo anywhere. They just see a property manager. The same pattern repeats across the industry. JP Morgan Asset Management put $415 million of equity into a joint venture with Haven Realty Capital, targeting $1 billion of build-to-rent acquisitions and development. That partnership has now built or acquired 65 communities worth roughly $2 billion. Blackstone took Tricon Residential private for $3.5 billion in early 2024 and committed an additional $1 billion on top, specifically for new build-to-rent construction. Pretium Partners, the largest institutional single-family owner in America with 97,000 houses, closed a $778 million securitization in July of last year, backed entirely by build-to-rent communities. It was the first deal of its kind, 2,020 newly built rental houses bundled together as a single Wall Street security. And the home builders are facilitating it. D.R. Horton's annual report, filed in October, disclosed that their rental segment sold 3,460 single-family rental houses for $957.4 million in fiscal 2025. Nearly $1 billion of new finished houses sold directly to institutional buyers, never offered to a family. This is the pivot. Here's where this story turns on itself. The pivot is real, the capital is real, but the math has stopped working. And Wall Street knows it. Start with the rent data. Cotality, formerly CoreLogic, publishes the most comprehensive single-family rent index in the country. Their December 2025 reading, national single-family rent growth came in at 1.2% year over year, down from 2.5% the year before. 18 of the 50 largest metros posted outright rent declines. In Phoenix, The exact metro with 13,113 new rental houses under construction? Build-to-rent rents on the horizontal apartment format actually fell 4.2% year over year in the first quarter of 2025. According to John Burns Research and Consulting, move-in concessions on those Phoenix communities are now standard at 6 weeks of free rent. Texas is at 6 weeks. Florida is at 5. You build for a yield that requires rent to grow. Rent stopped growing. The yield stops working. And once again, say it with me. Wait. It gets worse. The National Association of Home Builders, citing Census Bureau data, reported in March that single-family build-to-rent starts fell to roughly 68,000 in 2025, down 19% from 84,000 the prior year. The pipeline is already pulling back. The most recent quarterly data from RealPage shows build-to-rent construction pipelines contracted year over year by 58% in Austin, 46% in Phoenix, 38% in Atlanta and Charlotte. The bet itself is unwinding. Here's the real-world math on why. A typical institutional build-to-rent house costs roughly $250,000 to deliver on a finished basis. To hit a 6% stabilized yield on cost, which is the minimum institutional capital underwrites to today, that house has to generate $15,000 of net operating income every year. With BTR expense ratios running 35 to 45% of effective gross income per John Burns, that requires gross asking rent of around $2,100 a month. In a Phoenix submarket where rents are now falling and where you're handing out 6 weeks of free rent on a 12-month lease, your effective rent isn't $2,100. It's closer to $1,860. The yield collapses from 6% to roughly 5%, and institutional capital does not deploy at 5% when 10-year treasuries pay 4.56% for zero risk. Now, here's the controversial part, the take I'm willing to defend in the comments. The single greatest threat to housing affordability in the Sunbelt over the next 5 years isn't Wall Street buying too many houses, it's Wall Street building too few of them. The new rental supply that came online between 2023 and 2025 is the only force that has put any downward pressure on rents in Phoenix, Dallas, Austin, and Charlotte. If that pipeline keeps contracting at the rate it contracted in 2025, and Senate Section 901 is about to make sure it does, rents in those metros will re-accelerate by 2027. Most of the political rhetoric about institutional landlords is going to make affordability worse, not better. I know that's not the popular take. The data supports it anyway. I just made a take that the comments are going to set on fire. And I want them to. If you think we're wrong, tell me where the data breaks. If you think I'm right, hit the like button so this analysis reaches the people whose political assumptions about housing are about to cost them money in their own rental market. The disagreement is the value here. Bring it on. And let me rank this by who has the most at stake, most leverage to least. If you're a first-time buyer in Atlanta, Miami, or Houston, you're sitting on the most favorable buyer's window in those 3 metros since 2014. Institutional landlords are concentrating their dispositions exactly in your zip codes. They're selling lower-quality houses. Invitation Homes' chief investment officer said so directly on the April call. These are houses that don't meet their portfolio standards anymore. For a family buying to live in the home, they're often perfectly fine. And they're trading at cap rates in the low 4s, which translated into purchase terms means below replacement cost. If you've been waiting, this is the window. If you are a renter in Phoenix, Dallas, Fort Worth, Austin, or Orlando, you have negotiating leverage you haven't had since 2010. Concessions are standard. Renewal rents are barely above flat. Push back on every increase you receive this year. The data is on your side and the landlord knows it. If you're an existing homeowner, your equity is no longer threatened by institutional bidding above asking. That era is over. Per Yardi Matrix tracking, institutional operators with portfolios of 1,000 homes or more own roughly 3% of total single-family rental stock in the United States, and they are now net sellers. The story that Wall Street is responsible for your local home prices was always overstated, and right now, it's functionally obsolete. If you're a real estate investor, the concentration risk is the entire story. The Sunbelt build-to-rent pipeline is oversupplied. Cap rates are inside multifamily. Operating expense ratios are running 35 to 45% of effective gross income, higher than apartments. If you own SFR exposure in Phoenix or Austin, your 2026 NOI growth is going to disappoint, and the institutional disposition wave is going to compress your exit cap rates further. Reprice your underwriting now. And then there's the policy overhang. On March 12th of this year, the United States Senate passed the 21st Century Road to Housing Act by a vote of 89 to 10. Section 901 of that bill, which is the section every institutional housing executive in America is reading right now, does two things. First, it would prohibit any single owner of 350 or more single-family homes from buying any additional ones. Second, it would force existing build-to-rent communities to transition to individual ownership within 7 years. On American Homes for Rent's most recent earnings call, CEO Brian Smith said directly that the company is reducing 2026 deliveries from roughly 2,300 to roughly 1,900 houses, explicitly citing regulatory uncertainty. The Capitol is frozen in place while the House of Representatives decides what to do with this bill. The National Association of Home Builders position, Section 901 as written, puts roughly 40,000 new rental housing units per year at risk of cancellation. CBRE Research, citing U.S. Census Bureau data in January of 2024, put the U.S. housing shortage at 3.9 million units, with the entire shortage concentrated on the single-family side. So the political effort to stop Wall Street from owning houses is, in net effect, reducing the rate of new housing construction in the metros with the worst affordability problems in the country. That's the slowest motion policy reversal of any affordability crisis we've ever watched in real time. If this is the kind of analysis you want, sourced to federal filings, earnings transcripts, census data, primary research firms only, with no rage bait and no secondhand framing, subscribe and turn on the bell. That's how this channel survives without taking sponsor money from anybody who owns one of these companies. Next video, we're doing the exact opposite of this one. We're naming the 5 Sunbelt metros where build-to-rent oversupply has already broken rent growth, the specific zip codes inside them where the discounts are deepest right now, and the one Midwestern market where the rental math is actually accelerating in 2026, while everybody is staring at Phoenix, names, numbers, zip codes. That one is going to land hard. The slowest motion pivot in modern American housing already happened. The people who made it are now quietly walking away from it. The only question left is whether the rest of us figure out what that means before the next leg of the cycle starts. I'll see you in the next one.